Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics and sit down with CRE experts to uncover trends, insights, and strategies that are shaping the industry today. I'm Shanti Ryle, Director of Content Marketing here at Crexi, and today we are so excited to sit down with Anthony Graziano, or Graz, as we may get to calling him later.
Some friends call me.
Who is CEO of Integra Realty Resources. Before we dive into today's conversation, which I'm very excited about, Anthony, let me share a little bit about you for our audience.
Sure.
So, Anthony is one of the nation's foremost experts on real estate economics and value drivers with over 30 years of experience providing valuation and advisory services to clients. He now serves as the CEO of Integra Realty Resources, or IRR for short, responsible for executing the strategic growth objectives of Integra's 55-plus offices across the United States and Caribbean. The firm's 500-plus professionals provide services to government, institutional, and private owners that include market feasibility studies and forecasts, expert witness testimony, economic damage assessment, and valuation and counseling on all classes of commercial and major residential and mixed-use projects. That's a lot of properties you're looking at.
A lot of properties in the world.
Yeah, sure are. Mr. Graziano is the chair of ULI Southeast Florida Caribbean District Council and chair of the Florida Counselors of Real Estate. You do a lot.
Thank you, Shanti. Thanks for having me today. Very excited.
Yeah, we're so excited to have you here in the studio. You came all the way out to Los Angeles. How are you liking it so far?
I am loving it. I just got back from the Urban Land Institute meetings, the fall meetings for ULI. We're in San Francisco this year. What an absolutely beautiful city. Had a fantastic time. 5,500 professionals from around the world.
Yeah.
And it was a perfect excuse to come down to LA for a couple more days and hang with you.
Yeah, get a little more sunshine before.
Yes, before going
LA
back to
gets
Miami
cold.
where there's no,
Yeah, there's no sunshine there.
it's going to be horrible.
Yeah, it's terrible. Yeah, the ULI fall meeting is always very exciting. I do a lot of reports writing here at Crexi, and that emerging trends paper is like my Bible for looking ahead to what'll be most interesting to take a look at from a data
It's a great
perspective.
report, and the ULI fall meeting is going to be in Miami, so maybe we'll drag you down for another Crexi podcast next year. See how we did.
Yeah, I'll talk to my accounts team, accounts
Okay.
payable.
All right.
So I know I just covered a bit about your background, but I'd love to get into more of your own story in your own words. So how did you first get into the world of commercial real estate, and what made valuation stick for you?
So I love this origin story piece, right? Where did you start it all? So traditionally, I started just like many, many good valuation experts in the world. My dad was in it. My dad was in the music business for many years. And when my mom got pregnant with me, he realized he needed to do something that didn't require so much travel. And so he got into the real estate business, ultimately becoming an MAI appraiser in the early 70s. So I grew up in the business. I grew up driving around looking at properties with him and talking about what was happening in the market and so forth. And, when I was a teenager, I needed a job. All my friends got jobs as lifeguards and bartenders and fun stuff. And I was the research guy, right? I was going down to the deed house and pulling the deeds off the rack and keeping
In line
track.
at the city office.
But I just, I got into it naturally because I had an interest in it. A lot of the skills in the business were just things that I love to do. I love to read. I love to understand people. I really enjoyed figuring things out, problem solving, doing the research side of it. And I stayed with it. I ultimately, went to school at University of Miami, studied urban planning, came out of school during the RTC Resolution Trust liquidation of all the banks under the savings and loan crisis. And when I got out, I started with my dad. I did my master's degree at NYU in real estate finance and development. Had tons of offers to do something in New York, but I was actually really enjoying being close to my family, working with my dad and so forth. And about 5 or 6 years in was when we started Integra Realty Resources. And that became the launch point really for the career that I've had, because our original partnership with these, we had about 20 members around the country that we started the company with. And I was the youngest by 2 decades. I was in the room as a 27 or 28-year-old, and everybody else was in their 40s and 50s.
Sure.
And so I was the only one that really knew anything about technology. And they really leaned on me to help them understand how to pull all the technology together. And that was the starting point of it. I helped them do their first strategic plan on the technology side. And from there, just stayed growing and investing my time in helping the company grow. My partners in Miami and Florida asked me to come run the Miami office. So I moved my family to Miami in 2012, ran the Miami office for about 8 years. And then the company asked me to be the CEO. And I said, as long as I don't have to leave Miami, I'm happy to do it. And so I've been the CEO since 2019, middle of 2019.
Wow.
Yeah,
What a journey.
it's been
Oh
fun.
my gosh. I
Been
mean,
fun.
that's is not many people that can say they've been at the same company since the beginning days.
It's true, and you know, at the same time, it's not the same company, right? So
Sure.
many people have come and gone, and the relationships that I've built and the things that I've done with the company, I'm very proud of. But at the same time, it's a new company every 5 years. Yeah, it's
Yeah, and that's
amazing.
the beauty of it. It's always evolving, especially in whatever marketplace or
Yeah,
emergent technology comes along. You got to
absolutely.
adapt.
And when you're growing, it feels you don't realize until you look back. And it's kind of the same thing with life, right? I think if you look
Mm.
back on your life, every 5 years is a big turn. And so, in a 25, 26-year career with Integra, there's been a lot of big turns, but it's been a great ride, and
Sure.
really, really happy with the people that I get to do it with every day.
Yeah. Do you want to talk about any of those? I'm very curious because, coming from the world of valuation, I've talked to a few appraisers that really liken it to an apprenticeship when they're first getting into the business. It's an art form. There is a science to it. There's a lot of math and econ involved with it, but you do have to rely a lot on your intuition, on experience, on the knowledge of others who have come before, right?
Sure.
So I'm curious how maybe in the early days did you focus on building up that skill set while simultaneously building the skill set you need to build the company? Because those are two totally different buckets.
Sure.
How did you think about investing in your own growth or skills you needed to do each of those things simultaneously along the way?
It's a good question. I guess probably in my 20s, I wasn't as intentional about it. I really
Mm.
was more focused on just being the best. I just wanted to be the best. And that meant getting exposed to mentors that could help me. And I
Mm.
had a great many, my father included. There's a gentleman in northern New Jersey, Ray Sears, and Barry Krauser, who were super influential.
Mm.
And then, of course, as I grew into Integra, there were a tremendous number of people that were super important in my career, Mike Cannon and Steve Matonis, and these were all MAIs, people that were leading uh, guys and women, Shelley Lowe in Las
Mm.
Vegas, in their markets. And I just took the opportunity to learn from them as much as I could, right? And so probably by my early 30s, my strategy, if you'll call it that, was to just build relationships and learn as much as I could from each person in my life. And it's really just paid huge dividends.
Yeah,
Huge dividends.
absolutely.
It's been great. And not just learn about the market, really learn about life, learn about business and perspectives. And it just gives me a very, very broad perspective. I will say you're absolutely right. I think in the valuation world, there's a lot of emphasis on this sort of master apprentice or like a mentor model where people are working one on one. I just had this fantastic opportunity to work one to many. I had a lot of
Mm.
mentors, a lot of people that were doing different things, and it's what allowed me to get exposed to so many different areas of the business.
Mm.
It's just lucky, I guess.
Yeah. Do you think that's something that, younger appraisers coming into the industry today should consider more seriously? That exposure to multiple modalities, multiple theories of appraisal, multiple mentors, as opposed to just having one person that they hang their hat with and learn from?
I think it really depends on your opportunities. I think it's always helpful to diversify and learn from
Mm.
more people in your life. I think that's just a good general rule.
Hmm.
At the same time, I wouldn't encourage people to jump around. I think the most important thing is that they commit. And I think it's hard. It's more difficult today in the valuation field to attract good, talented people because the earnings capacity in the early part of your career isn't as good as maybe some other opportunities in the real estate world.
Mm.
It's also not recognized as like the sexiest part of the business, right? People get out of school, they want to be developers, they want to be investors. They have this idea that
Mhm.
they want to get straight to the top, and they look at valuation and they say, well, do they want to do it? But valuation is the
Is the
starting. It's the
business.
business. It's the whole
Mhm.
business. Whether you're an investment, whether you're running a company, it's fundamental. So, I would say the most important thing for the young kids today is to just really focus and be intentional about committing to the business, and that starts with committing to one mentor. because that mentor wants to know that the time they're investing, they're going to have someone long term. I think that's important. But then as you grow in your career, you're going to naturally find other people that you're going to learn from. So
Yeah.
just keep learning, make a commitment, and just keep learning.
Yeah. Be open.
Yeah,
Be very
absolutely.
open. I'm curious, going from the valuation side to becoming CEO and now leading it for 7 years, I think,
About
of 20,
6 maybe.
2019,
Yeah,
7 years.
yeah.
What has evolved in your leadership style? How have you had to adapt and push yourself to go from running an office,
Yeah.
doing valuations, to running a huge company with over, you said 55 offices, I think is
Yes,
what it is?
yes.
How have you had to change to meet that
So
challenge?
it's a good question. I would love to tell you that I have this comprehensive view of my leadership style. But I will tell you that it's pretty simple, right? It's really, and I think running the business, running a staff of real estate folks, it's all still tied to the same thing. I started thinking about leadership at a very young age. I was involved in the Boy Scouts.
Were
And
you an Eagle Scout?
I am an Eagle Scout.
Ah, so it's my husband.
I am an Eagle Scout. I get a little bit of razzing about it here and there, but ethically and fundamentally, I love it.
It's a great foundation for
I still am an
sure.
Eagle Scout.
Yeah.
But when I got involved in the Boy Scouts early on, I didn't do it to learn leadership. I did it because I wanted to go camping, right? And then you get in there, and all of a sudden, there's all these things. You take a big project and you break it down into smaller steps. You want to be an Eagle Scout, you don't do that in one bite. There's a lot of planning that goes in, and you have to think about it forward. And you're trying to motivate others to do it too. And naturally, I just ended up in all these leadership positions through the Boy Scouts. And what I learned is just identifying a big picture mission and then getting everybody to want to do that with you. That's leadership. That's all it is. And it's not any different if I'm running a 5-person team or running a 500-person team. And it isn't any different from the time I was 15 to now when I'm 55. If you can crystallize for people the why are we doing this? Where are we going? And why do we want to get there? And you get everybody behind you, it's going to go. And keeping that momentum, keeping that enthusiasm. There's a lot of little things in the interim, but the big secret to leadership is just having a good vision of where you want to go, and then being able to communicate that to everybody to get behind that idea. And then once you've got that, it just flows.
Yeah, the clear communication and the persuasion
Yeah.
definitely comes in handy. So speaking of persuasion, I think that's a good little segue into more of the valuation side of things.
Sure.
So you've done all sorts of valuations, air rights, title disputes. I'm sure some cases a little more challenging than others. Are there any examples of projects you've worked on that come to mind that have required you to upskill yourself as an appraiser, where you've never seen this challenge before maybe, and you had to go learn something new, or there were particular personalities involved? Anything that comes to mind that really asked you to level up?
Sure. There are so many. I'll tell you that, and I don't mean I don't want it to sound arrogant. That's not my point. In this business, when you sort of get the fundamentals down and you're working on assignments, you can get in a rut. You can become really good at one thing, then everybody relies on you for that one thing. And what I did was I became really good at one thing, and that was solving complicated problems that nobody else wanted to solve. And so I would say there were many times in my career, I had an environmental contamination case that was about a 12-year-old case. It was a massive Superfund site. There were a lot of difficulties around how do you value this Superfund site? What's the alternate reuse? What is the town going to let you do with this site? Because there was a lot of political issues around redevelopment of the site. And all of a sudden I was thrust into this, few $100 million, $500 million property that had this environmental contamination. And I had to start understanding from beginning to end what were the restrictions. I did a case. So I don't know if there's back in 2005, 2006, when the residential real estate market was really booming, we had a drywall shortage. And we source most of our drywall in the United States between Canada and the U.S. That's where our drywall comes from. And there was so much building happening at this time that we had this drywall shortage. So we started to import drywall from China. And that drywall had a defect. It had a chemical defect that caused the drywall to corrode the wires and put a sulfuric acid into the air.
Oof.
And a lot of the major builders around the country used that drywall in the construction of these major 1,000-unit tract projects. And there was a class action lawsuit against this drywall manufacturer, and damages were at issue. And it was a class action suit that then got remanded back to the States. And so I got involved in this deal to understand like what were the damages. And it was a hugely interesting assignment, right? It was the science of how this happened, but then more importantly, it was the behavioral psychology of when you have this issue, even if you take all the drywall out, replace it all, is there stigma on the properties thereafter? What is the perception of a market buyer? Is this ever fixed? So I love these ideas that challenge what the market, how the market will react when there's not a lot of clear market evidence. And so I've gotten all these challenges because I just love to dig in and understand and study and research. But the reality of it is all of real estate valuation requires you to go into a problem with an open mind and learn. Every assignment, there's something to learn, I find. Even some of the most simplest ones, always you'll find a wrinkle.
Yeah, that's so interesting because in these unique one-of-one cases, you do have some numbers, but it sounds like it's so much more about the psychology and the psychological fallout of the different parties in the determination of whatever the resolution is. So,
and you have to go out to the market. You have to talk to people. You have to talk to the
Yeah.
people that are the players in the market that are doing the deals, whether it's the brokers, the buyers, the sellers. Yeah, having that contact with the marketplace and then really being able to sort out what the trends are and what you're hearing from people and what that really means and how that translates into value. That's the fun part of the job.
Yeah, that's so interesting. So I guess in those high stakes scenarios where, people's health, people's money are on the line, you have to backtrack. There's a lot of victims of an issue like this
Sure.
drywall situation. How do you handle the pressure or maybe compete? Like you have to be arbitrator, right? So how do you juggle all these different competing interests, these different cases that are being brought to you, and how do you think about weighing what is the most fair assessment
Sure.
at the end of the day?
So if I'm in an arbitration situation where I'm the decider, it's a little different, right? But if I'm preparing an expert report, a third party expert report
Yeah.
on behalf of or
I guess
one
I shouldn't
or
use the
other.
word arbitration
I
because
just wanted
that's
to be
got weight
clear.
to
It
it.
can
But
that can happen too.
Yeah.
But my job obviously is to do as credible a job as possible and support
Yeah.
the opinion. And when we've done our job, I don't know. It's just something about me. I don't ever think I'm wrong, so I don't worry that much. I don't spend a lot of time over analyzing whether somebody thinks I'm right or. I mean, my job is to communicate to the court. This is my opinion, and this is what the foundation of my opinion is. And then the court is in charge of deciding one way or the other. There's no magic bullet. It's really a matter of just being able to put an opinion in front of the court that the court can accept and understand what you did. And then they're the ones that weigh the merits and the equities and worry about the balance and the precedent and what all of that does. I don't have to worry about any of that. My job is to just give them a good, solid answer that's well supported and that is understandable. And if I do
Yeah.
that, I've done my job.
Yeah, well, totally makes sense. I'm curious, before we start getting more into the market as
Sure.
it stands today, what do you wish more people understood about valuation? Maybe more so as a discipline than just as a third-party service or someone
Yeah.
to talk to in a court situation.
I summarized this best last year. I was in New York City at the Shack Institute, had done a real estate conference in New York City. We had about 125 of the nation's top real estate people, not only real estate valuation firms. Most of the major ones were there. A lot of the New York players were there, but also the pension fund advisors and institutional money, and a lot of the major banking chief appraisers were there. And I was on a panel with 6 people, and I got this question: what does the appraisal industry need more of? And so I was at the end to answer the question last, and that's always dangerous, right? Because everybody takes your good answers. They whatever's on your mind, they
Yeah.
steal an answer. And so everybody sort of went down the line and it was like, we need more data. We need more benchmarking tools. We need more analysis. And as I'm listening to this, I'm like, this is not the answer. And I just sat there and waited and it got to me. And I looked at the audience and I said, if I could change one thing about the valuation business in terms of our perspective of what makes us good, we need better storytellers. The real trick in this business, the data's available, the data's out there, your ability to talk to people and call people and influence them and understand like how to get them to give you information. That's a skill. But once you get good at that and you're able to collect information, the real point is how do you pull it all together to make it make sense, to tell
Yeah.
that story? And we've lost that in this age of data where the data is just flying everywhere. Everybody thinks that real
Mm.
estate valuation people are data brokers. Like, oh, we're just going to give you the data and then you're going to know the answer. And the reality is we're actually more awash in data today, good data, bad data, poorly scrubbed data, but nothing's analyzed. It's just all flying out there and everybody looks at it and they go, oh, well, that's obviously the answer. The holy grail, of course, is that the computer would serve us up this magical answer and all the data would come in and you'd push
No.
a button and get a value. And that's not really the value. That's not really a value. The value of a real estate valuation is that the reader understands how you got to the answer.
Hmm.
So I tell everybody all the time, if I could invent a system that would deliver a valuation answer, it would be unsellable
Hmm.
because I couldn't tell the client what the black box answer was behind it. The reason we succeed as valuation professionals is we do two things. We gather all that information, but we tell the story as to how we got there
Yeah.
so that the user of that valuation can say, I believe that. It's credible.
Yeah.
I understand it. I may not agree with it even. I may not see, I may have a different perspective, but at least I understand how he got there. And I would say if there's one thing that's critical in our business, it's better storytelling.
Yeah. To me, it sounds like you need to hire theater majors.
I will tell you, we spend a lot of time thinking about recruitment
Yeah.
and who the ideal professionals are in
Mhm.
our business. And we sort of have a profile, but I will tell you, it's not as if I have to get people from Harvard or Yale to do this
Mm.
business. It's not that kind of a business where I need these quantitative geniuses to do the business. I can take someone with good skills and curiosity from Florida State University or Kent State or
Yeah.
the UC Santa Barbara. If they're reasonably intelligent and they're curious, we can make them good appraisers. It's like making Marines, right? Marines
Yeah.
aren't born, they're made, they're forged. We
Mm.
can forge great valuation professionals with someone that's curious and motivated.
Yeah.
Yeah.
I love it. My last question before we get into it was about advice for younger appraisers, but I think that's great. Be curious.
Be curious, stay curious.
Yeah. Be willing to be forged too.
Yeah,
I think. I
absolutely.
think that flexibility is also very important. All right. Time to get into the fun stuff.
Let's do it. I love it. I love it.
So we are recording this. Oh gosh, it's November already.
It is.
So
Almost Thanksgiving.
almost Thanksgiving, 2025, which means 2026 is right around the corner.
Yes.
So ahead of us getting into this new year, what is your current read on property values across the major asset types that you guys are involved in? Where are you seeing, valuations being pretty on the money? Where is there maybe more of a bid-ask gap? Or, where are the macro factors playing into it more or less? I'd love to get your 30,000-foot overview of what you're seeing.
Well, of course, last year everybody was, survive to 25, survive to 25. And 25 has turned out to be okay. It hasn't been a stellar year. The trend, obviously, if you talk to economists and you listen to what the economic forecasts were, and then you talk to the institutional side of the business, everybody in March just sort of stopped. They didn't know what to do. Tariffs were weighing, the economic direction was weighing, and so there's no really single answer on where we are in the market because it depends where the buyers and sellers are.
Yeah.
But the major buyers and sellers on the institutional side in the first quarter basically hit pause, and then they hit pause again in the second quarter. And I kept saying, well, they can't hit pause all year because they have real estate allocations to fill, so it's going to pick up, and it has.
Mhm.
The third quarter's been a bit better, but I really thought we were going to rock it. Like I thought we were going to light it up in the third and fourth quarter to make up for lost time, and we really have not. And so there has been this sort of general malaise, like, well, there's no good deals, and I don't want to trade in or trade out. If I can change my allocations a little and trade in or trade out, great. But everybody was super hot on industrial for the last 4 or 5 years,
Yeah.
and that started to cool. So I said, from a macro view, in most markets, industrial real estate right now, relative to values that were put on it 2 years ago, that's cooling.
Yeah.
Multifamily is the same way, right? In a lot of markets where there's a lot under construction, where 3, 4, 5, 6% of inventory is delivering, we're starting to see softness in rents. We're starting to see more concessions. And what that's doing is it's changing the revenue side of the business, while at the same time expenses are escalating. So that's putting a lot of strain on these projects, particularly if you bought that project in 21, 22 at the top of the market, you were racing for safety into multifamily. Now all of a sudden your interest-only debt's up, and you're trying to refinance that deal,
Yeah.
and it looks underwater. And that's part of the problem too. Part of the problem is the asset values had increased so much post-COVID with the zero interest rate policy.
Yeah.
The Fed reversed that, and everybody woke up, and now they were saying, well, I bought this thing with a 6% yield, and now I can get 4.5 or 5% on my cash sitting in the bank.
Yeah.
So there's been a lot of sort of wait and see, stop and start, hold. There are still markets, obviously, where there's supply constraints, where construction costs are elevated, and so you're still buying at a decent price. But then there are other markets, suburban Chicago, for example. There's trades of vacant suburban office buildings from the 80s that are trading at $30 a square foot or $25 a square foot. And so, people are looking around saying, why should I pay $400? There are the opportunistic opportunities in 26, I think, are going to be pretty good.
Yeah.
Now, of course, if the Fed continues to knock interest rates down, that kicks the can down the street a little longer. But that's where we've been. We've been in can kicking mode. Everybody's trying to hold their valuations up. They're trying to justify the valuations as best they can so they don't have to retrade. But anybody that wants to actually transact, the sellers need to get reasonable. And then you've got to find buyers that have a little bit of risk tolerance and, more importantly, capital availability.
Yeah.
The banks are still active. We haven't seen the banking industry pull back per se. They're just being more selective. And they're watching their allocations too. So once they get filled up in a bucket, they say, well, we're not doing any more office lending, or we're not doing any more multifamily lending. So you need to find another bank. So this has just been a period of, I'll call it a recalibration. I think that there is a lot of concern, at least on the big, the REITs and so forth. The public markets have punished valuations this year to a certain extent. But everybody's feeling about the economy weighs into that too. Right?
Yeah.
Where's the economy going?
Yeah.
And that's what's really put the hold is the uncertainty around the economy. I've been in, 18, presentations in the last 20 months where the buzzword was uncertainty, tariffs and uncertainty.
Yeah.
I saw Mark Zandi at the NACREIF conference about 3 or 4 weeks ago. And Zandi had a great point. He said, the United States right now is dealing with two competing forces. One is the competing force of uncertainty and volatility caused by tariffs, public policy, political infighting, the direction of the United States, whether we're going to be a free market economy or we're going to try to, do everything on the other side. And at the same time, we're primary beneficiaries of this AI revolution that's just drawing a huge amount of tech money.
Yeah.
And all the way downstream, because the technology money and the AI money also translates into, infrastructure spending and power. And there are secondary and tertiary plays to make underneath just technology, right? Because you can invest in technology, but you can also be investing in power down the line. You can also be investing in data centers. So there's all of these second and third order effects that's drawing all this money into the U.S. And so we have these two competing forces that right now are kind of balancing everybody out. But that old saying, right? If your ass is on ice and your head's in the oven, on average you should feel good, but it doesn't feel very good. That's kind of where we are at the end of 25.
I've never heard that saying before.
I'll give you a couple old schools.
I'm gonna steal that. That's fantastic.
Thank you.
Man. Wow, there's so many different directions we can go with this. I am very curious, kind of to pick out two of the players that you mentioned. One was on the REIT side. They do have to transact. They have an obligation to their shareholders. They have to hit certain investment goals, certain targets, and that means that they have to play in this market. So I'd love to know kind of what you're seeing in terms of how they're thinking about the next year. And then on the flip side, there's a lot of debt coming due in 2026, 27, 28. And, maybe not as much on the REIT players, but how are those folks who do have those debt obligations that they maybe originated in 21, 22, how are they thinking about their ticking time bombs from a valuation perspective?
Sure. I'll let me take the second part first, if you don't mind.
Sure.
So I don't believe in the debt wall anymore. I've heard of the wall of maturities, be touted so much, the wall of maturities. As a consequence of people saying like, and then if this doesn't happen, then what's going to happen? A couple of forces come into play there. I see it every time, and so I don't put a lot of stock or worry into this wall of maturities because they're timed out over time, and the lenders will kick the can down the road so that they don't have to act. There's a lot of money in the marketplace. There's a lot of, debt money in the marketplace where the debt players don't understand how to work out. So they don't have a choice. They don't have the infrastructure to foreclose. They don't have the tolerance. The state laws against foreclosure and possession and all that are much more difficult. And the evolution of the finance world has brought a lot of tools to sort of help bridge that gap on the wall of maturities, right? We see mezzanine lenders coming in and bridging that gap where there's a whole process of private money right now that's out in the world lending. And then going back to the banks and basically saying, hey, we're taking this out. Do you want to come in with us and we'll give you, a 60% position on our debt, so that they're basically acting as shadow CMBS, right? There's an A piece and a B piece and so forth. And then, of course, you have the CMBS market, which is really functional to bridge some of this. So, and then you just have the general finance world, or the real estate banking world, that's been getting more sophisticated, nationalizing, deregulating the banks to allow interstate banking. We've got all of these now big mega banks that can transact in a lot of markets with very sophisticated execution strategies and growth in mind. And so the wall of maturities is just basically telling me what's going to happen in the banking world, and they're going to make money in the next couple of years as they work this out. As are the mezz lenders, as are the private lenders, and it's I think from an owner investor perspective, the question is, how do you build those correct relations? How do you build good relationships there so you don't get taken advantage of? Sure. I think the evolution of the lending finance world in my career has been a lot faster than the evolution of investor sophistication.
Interesting.
Yeah.
Okay. Well, from that perspective, what's your advice to investors? I know I'm taking us away from the REITs.
No. It's
but how would you recommend they up their playbook and improve that sophistication so that they can have a wider array of decisions and options and levers that they can pull in solving these problems?
Yeah. So, we're seeing that happen now, certainly in the last 10 years. You've seen the professionalization of family office, right? It used to be the uber wealthy folks that had a lot of money. They went to their stockbroker to make their investments. And then on the real estate side, they managed their own portfolio directly. They would buy and sell and transact. Your grandfather that sold his company for a lot of money would be dealing with that directly. Now there are professional people that run these family offices to help generate, what they call G2, Generation 2, G3, G4 wealth. And it's a completely different mindset in terms of how they approach the business. And that includes how they manage their debt, but it also includes how they manage their estate, to manage for taxation. And they're thinking about the people in the family. How do I make sure that the grandkids just don't spend all the money? You can't give it to them all at one time, right? How do you time that out?
Sure.
I think the investors are becoming more sophisticated. Now, obviously, I'm not talking about new people that just started investing in real estate and they have $1 million or $2 million. I'm talking about people with, larger portfolios. But the folks that are in that sort of middle or lower tier where they're first-time investors, it's more difficult for them because they don't have they're trying to access money, and even when they go to the bank, a lot of times those banking institutions are much more sophisticated. So I would say learn, partner,
attach yourself to
find your way by understanding that this is evolving. And also, don't be cheap about your attorneys. Your attorneys can really help you understand where the tricks and traps are. Even if you're smaller and scaling, the attorneys get to see a lot. So you think you're saving money on your attorney, believe me, you're not. You're not.
Spend for a good one.
Yeah.
Absolutely.
Find the right attorneys.
Taking it back to valuations. So since any valuation is built on assumptions, comps preferably, but you got to kind of broaden your understanding of what constitutes a comp in any given deal. How do you, IRR more generally, go about stress testing assumptions in market conditions like this where the golden buzzer word is uncertainty?
Sure. It's a good question. So the starting point, obviously, is that the quote what you're terming assumptions, in our view, are the fundamental inputs, right? They're but ultimately you reach a conclusion. I don't want it to be an assumption. It should be almost in your mind as a valuation professional, a provable fact. I'm using the comps to show you how I got there, to show you that it's within what's happening in the marketplace. But, there are also valuations where you can go out and have 5 comps and you're at the top of the market. And sometimes you have to say, there is no comps. I'm at the top of the market. Or the comps that traded aren't exactly like yours. And you have to say, it's below this. The point of the comps is to just validate that, this is the right point. When you say stress testing, now what you're saying is, hey, there's a tolerance in each one of these inputs. How does that affect the outcome? Because there's a range of pricing that occurs. And that's a really good dynamic question. We used to define market value as the price, the highest price that a buyer would pay, et cetera, right? With all conditions, no undue duress. But we would say buyer and seller typically motivated, no duress. What's the highest price that you would achieve with the property? And that was the definition of market value. Today, it's not, the highest price isn't the answer. It's supposed to be the most probable price. And so this point that you're saying about testing assumptions and getting to a most probable price implies a probability. This causes a lot of problems with clients because they say, I'm not going to sell at the most probable price. I'm going to sell at the highest price.
Yeah.
Right. And we have this concept of highest and best use. What's the most profitable thing you can do with the property? And the most profitable thing you can do with the property is build it, operate it. And then when somebody comes along and pays you the higher price than you think it's worth, that's when you sell. So I see appraisers doing, 10-year cash flows. Everything's a 10-year cash flow. And I say, no, that's not when you sell. You don't sell in 10 years. You sell when you've maximized the revenue to its peak and you're at the point where your debt's not coming up, your leases are still at a durable place. I see a lot of appraisers do 10-year cash flows, and all of a sudden in the ninth year, there's this massive rollover.
Yeah.
Or the 11th year, there's this massive rollover. Then don't do a 10-year cash flow.
Yeah.
You're going to sell when you get that lease renewed, right? So I would say that the way we view this is there's always a range in price because I can change these assumptions and demonstrate that it could be higher or it could be lower. What we're trying to do is we're trying to get to the most probable. And in a strong market, when there's a ton of buyers, that might be a higher price than in the current market when there's fewer buyers, more uncertainty, et cetera. You might tend to be towards the middle or even maybe a little lower. I think it's also important that, hey, here's a comp set, but also you should know, here's the comp set, and these stabilized office buildings in this market are trading for whatever, $250, $275 a square foot. But you should also let the reader know that there's been 3 recent transactions of vacant buildings for $40 a foot. Don't forget that. Don't forget that you have to tell that story. What else is happening? I think good valuation professionals do a good job arraying all that and then putting in front of you and saying, this is why I came to this conclusion. And these are not assumptions anymore. These are sort of known facts. Within some range of tolerance. If you can do that, I think you did your job.
Absolutely. No, I appreciate that overview. Something I do want to get into, because we did talk about it on our prep call, is where does bias sneak its way into play? I think, recently there have been some conversation in the public space about the fairness of appraising, and I think more on the residential side than commercial. But, something you just commented on was a good appraiser is a good storyteller, being able to pull the right pieces of information that best inform the context in which I put this set of numbers together for you, and here's my reasoning for it. So how does one double check for bias? Because obviously experience plays a huge role, but you also don't want to get got down the rabbit hole of how do I know what I know, and then second guessing and never actually getting to a number. And then how can the appraisal industry as a whole move towards trying as much as possible to eliminate bias? Does that come from the data side? Does that come from integrating tech tools more? I'm just curious. It's a lot of question, but
I mean, we could do a whole podcast on this. And this absolutely is an area where I am very likely to get in trouble. But I'm going to give you my best shot at this and see if I can say say this the right way.
Sure.
Right? We start with the fact that you have to know what your own biases are, right, as a person. And I think forgetting about appraisal for a moment, just living your life, you need to understand that everyone is biased. And this has really messed people up in the dialogue professionally. Because on one hand, appraisers say, I'm not biased. And then the social psychologist would be able to very easily show you how you are. And so it's this dichotomy inside of us that says, I want to be independent and I want to be objective, but I'm biased by very nature. It's impossible not. The question is, does the bias influence your decision? That's the leap. And I would say that the appraisers have been completely smeared in this regard. And I think the Appraisal Institute as an association has done a terrible job really drilling in on the evidence used against appraisers for bias. Now, that is not to say that there are not residential appraisers out there that might go into a neighborhood that's not normally where they would live, and they categorize it wrong, or they do something. I mean, that's a natural thing that can happen, but it's nowhere near systemic. My experience with valuation professionals is they want to do the right job. Their career is important to them. Jeopardizing their career with silly bias mistakes are not. We take standards every 2 years. We're strongly ethical on the whole. And I always say, by the way, in any group of people, you can take 100 policemen, there's going to be a few bad ones in there, right? You can take 100 of anything, and there's going to be a few bad ones in there. I'm not saying that the valuation industry is completely devoid of any person that has any biases or racist to that might influence their opinion. But on the whole, I would say this profession is very ethical. That said, the Brookings Institute published a study about 5 or 6 years ago where they compared the values of real estate in black neighborhoods versus predominantly black neighborhoods versus white neighborhoods. They did this at a time where there was a lot of discussion around social equity. We had a number of massive national trends that were happening on the scene. At the time, I think this was the tail end of the first Trump administration. There was that tension between white nationalism and the social equity movement that was happening in the United States. For historical context, I memean, I'm not old enough I was born in 1970, so I didn't live through the 60s, but I studied it, right? Because it was only 10 or 15 years history. By the time I got to high school, we were living through this time of huge social change in the United States. And it's confusing and disorienting to many because it's 50, 60 years past when we did it the last time. But all of these trends are happening, and all of a sudden the Brookings Institution does this study that says that appraisers are undervaluing black neighborhoods, and as a matter of social equity, we have to look at at appraiser bias. Representative Maxine Waters who's on the finance committee, does a huge investigation around it. The New York Times gets involved because, of course, they need to follow, and they write a story or two. But the Brookings Institution shows up before Congress to testify before Congress to talk about their study, and the Appraisal Institute sends 3 representatives, 2 white guys and a brilliant woman, and they went there to talk about the de minimis threshold. They thought they were going to Congress to talk about the de minimis thresholds of when you need an appraisal. When should a bank have to order an appraisal? For homes over $1 million or under $1 million, you don't even need an appraisal in many markets. So the Appraisal Institute shows up to talk about that. And the Brookings Institute comes to talk about racial bias. And they present this study. I don't know if they didn't read it. I didn't know if they didn't prep it. But basically, the Brookings Institute methodology was to look at real estate tax assessments, which are tangentially appraisals. But there's a tremendous difference between
the assessor's
individual appraisals that you would use for financing and what the assessor's office used to get to a common level. That sets off a firestorm of fear in the industry between the Appraisal Foundation and the Appraisal Institute. And they, instead of being proactive and actually doing their own study of appraisals, they go and they start being reactive. They form task forces around bias. They start offering bias training. They start telling appraisers, you can't be biased. And they go this whole route around the education of appraisers. And they basically get the appraisers to all get scared, like we're going to lose our jobs. In the meantime, there was some trends to possibly nationalize certifying appraisers and doing away with some of the state level infrastructure that licenses appraisers.
Sure.
And all of a sudden, all the residential appraisers felt like their career is at stake. The other major trend that's happening, by the way, in the residential world is the poor residential appraisers are almost out of contact with their clients at this point, meaning the banks. They are working through appraisal management companies, and they're getting paid. The appraisal management companies charging the bank $700, $800, $900, $1,000, and they're giving the appraiser $200, $250, and they're keeping the rest for appraisal management. Now the appraisal management companies start to say, well, we have to manage bias. So they're getting appraisals from the appraisers that are working for a third of the fee or a quarter of the fee. And now they're saying, You can't use the word white. You can't use the word black. You can't talk about a neighborhood being in transition. And they start to manage the language with which appraisers are able to talk about real estate. And that becomes extremely dangerous, right? When we start to have manage the way in which I can communicate with you. Because as I said before, my job is to be credible and tell the story. And now you're taking the words away for me to be able to tell the story. Now, I'm not talking about, you shouldn't be able to say, this is a predominantly black neighborhood and nobody's going to want to buy here. That's ridiculous. Nobody's saying that in the appraisal world. But you have to be able to say that this neighborhood is not as good as this neighborhood or this neighborhood in terms of overall context. Who's going to want to live in this neighborhood with a weak school system, poor safety, et cetera, et cetera? And if you can't communicate that, and then they started to sort of rule make around there should be no neighborhood boundaries. You should be able to take comparables from other neighborhoods and compare them. And the Appraisal Institute and the foundation have just sort of continued to react. And nobody's really done anything more than say, we're going to train our appraisers to do better. And the reality of it is it was all based on this initial study that was flawed, in my opinion. So it's been a shame. I think the best thing we can do is to just keep doing the best job we can. And just be credible. Just do the job. Keep our heads down. We, as evaluation professionals, we always take a lot of heat. You know, if the banks all go bankrupt, they say, "Oh, the appraisers did it wrong." Right? If they lose money, "Oh, the appraisers did it wrong."
It's not the number that they want to hear.
Investor
it's
loses money. He says, "Oh, I would have never bought that if you hadn't appraised it for so much." Like we are the whipping boys of the industry, if you will.
Yeah. And I mean, it's, I think exactly like you said, the credibility piece and doing good work is the best proof in the pudding.
That's it.
That you can offer up for sure.
That's it.
So in, this new world, and I do want to kind of loop in the technology component since we talked about AI a little bit earlier.
Well, and also since it's the Crexi Podcast, right? I mean, let's make sure we talk a little bit about technology.
I'm a little biased, sure. Speaking of bias. But I'm curious, kind of with, and we'll see, how long this framework of wanting to shape how valuations are reached and talked about and communicated with the people you're providing them for, how that evolves over time, right? But, this industry is, I think, also going through a bit of a transformational mode in that you mentioned earlier, the point of entry from a salary perspective isn't as high value as it could be in other corners of the real estate world. How do you think about this new generation of appraisers coming in? All these different flux points that are happening, it's changing, right? The industry is not what it was 10 years ago. So how do you think this next generation of appraisers can come into this world, bearing in mind that these are the conversations happening right now around bias, bearing in mind that AI is coming in and you said I can never make a machine that I could press a button and get a valuation because that's not the story. How do they find their way in this almost more? I feel like this corner of commercial real estate is almost being the most transformed by what's going on right now. So I'm just curious what your thoughts are on any of the things I just said.
I think that this is going to be actually a really great time to be in the real estate valuation world in the next 10 years. I think the opportunity is it's going to require a skill set that's a bit different. But I think that the opportunities for our ability to use the data and better interpret the data is the big opportunity, right? Because we can leverage and have more productivity. We can increase the productivity of an individual through the tools that we're giving them. And we've seen that even happening in our business, right? We track, one of our KPIs is sort of productivity per person, how much someone can produce and bill, and all of that's factored in with fee levels and the type of work they do and whatever. But the main point is we're seeing real strong gains in productivity in our business, which is good for the people that work in our company. At the same time, for the new kids coming in, I think we're going to have a different expectation of what they can do, but they're coming with digitally native skills, an embedded level of productivity. I look at what, my girls are 19 and 20. They're in college, and I look at the things that these girls are able to produce at 18 or 19 years old. And I think of little old Anthony, at the typewriter with double spaced, and it would take me weeks to get out a whole thing and a whole, 3-page paper to turn in or something. The productivity of the students today is tremendous. It's
Hmm.
really going to be about us instilling how to add that intuition, how to read the market, how to make sure that they don't live in the computer, they get out of the computer and talk to people on the
Mm.
street. Getting them actually out of the computer is going to be the challenge, right,
Sure.
for us to train them on how to get to not get distracted by all the digital noise.
Yeah.
But the fact that they're going to have these productivity tools, I think, is going to be transformative. We're seeing we have a lot of newer employees that they're pressing us.
Hmm.
Like they're coming to us saying, why aren't we doing this? Why aren't we
Yeah.
building an index? Why aren't we arraying all this data in Python and running out a long-term statistical analysis of
Yeah.
the right? And so these kids have an opportunity to innovate
Yeah.
and really think about the business a different way. Um, and so I'm excited for them.
Yeah.
And my challenge, honestly, is to not be so old school that I don't encourage them to push the boundaries and do those things.
What a nice
Um,
turnaround that, when you started at IRA, you were the one that's like, well, I know technology, so let me bring all this to the table. And now,
That's right. The challenge of getting old is to realize that at some point it doesn't matter if you thought you knew everything. The new things you haven't been able to keep up with the new things, right? So you have to lean on that younger
yeah,
generation. And my mentors did that for me. That's how I got the shot, right? Because
yeah,
the older folks in the company said, he knows more about this than I. Let's let him run with it. And
yeah,
so there's that time. And I hate to say it, but I don't have gray hair because I don't have any hair. But I'm approaching that time in my career when I'm going to have to say, you know what, show me what you can do, kid. Show me
yeah.
what you can do.
No, I
I'm
love it.
excited for it. I think it's going to be in all segments of the business. I think the transformation that we're going through right now is going to help us increase productivity per person.
Yeah.
And I think that we're not talking about that. We're worried about people losing their jobs. Oh, this job isn't going to be available anymore because AI is going to take this job and AI is going to take that job. Well, the
Mm.
automobile did that too.
Hmm.
In any period of economic growth, when there's innovation, there's always been displacement of jobs, right?
Yeah.
That's the old story about the buggy whip maker, right? Um, so I think there is going to be displacement in a lot of different careers. My bigger concern right now is not the technology. My bigger concern is the geo arbitrage, where we're
Hmm.
seeing major companies moving their back office accounting and back office functions overseas so that they can
Mm.
buy engineering and technical talent in other countries for $3 a square foot, but it costs them $30 a square foot here.
Hmm.
And what we're doing is we're actually exporting our intellectual property to other countries.
Mm-hmm.
And we're not giving the opportunities to the younger folks today to say, let's go do this
Yeah.
together. And so we're not giving them those opportunities and we're not building into that. And we're leaving that intellectual property in other countries. And I think
Hmm.
that for me, that's the biggest trend that I'm resisting. We don't have any overseas contracted relationships.
Hmm.
We do everything in the U.S. We don't move. A lot of our industry colleagues have been moving what they call their back office, file setup and everything overseas.
Yeah.
But how do you control the data? You just took all of your clients' confidential data and you uploaded
Yeah.
it to a server, and now you have people overseas accessing that data. I don't think it's a good trend for our business, for our
That's
industry.
yeah.
And Integra's been really solid on saying, no, we're gonna do what we do here, and we're going to train the next generation of valuation professionals. And, for whatever that is, we're going to forge new Marines, and we're going to do it right here in good old USA.
Yeah. I mean, here, but I really do want to double click on that trust component and that privacy component. I do think that's something that not enough people are talking about. I know people at other companies in the industry that have said, "Oh yeah, like I put this pro forma into ChatGPT," and it's like, "Oh, cool. Does your company have ChatGPT?"
Right.
And they're like, "No, I just use my personal
Oh,
account."
yeah.
And it's just like I we've seen a trend where there are escalating cyber attacks on different firms that have data centers in the United States, but many have also placed data centers abroad in different countries. And I think there's something to be said about how fast, particularly AI, is evolving as an industry, whereas the cybersecurity and technological security aspect is not catching up as fast. So, this is a weird way to get back into the valuation side and the data side in
Sure.
our industry.
Yep.
But from that trusting perspective, how do you think about what tools are the most trustworthy, whether that's from like a data accuracy perspective, a data privacy perspective. And is there a way you're thinking about balancing those things outside of just keeping everything on U.S. soil?
Sure, sure. Yeah, we do a lot of thinking around this. Somebody, I get asked the question, what keeps you up at night
Yeah.
often, and I will tell you that I just live and breathe cyber security versus cyber fear. I'm relentless about it. I'm always with my CIO sort of evaluating, and I don't want to put a big target on my back, the national podcast talking about cybersecurity entirely. But I will tell you, we start with what's the most important thing? Well, is that our client's data is protected. You start with that and you move from there. Okay, so how do we do that? How do we make sure it's protected and we move down the line? The side of the business that is how do you interface with AI, we had to get out in front of very quickly because immediately when ChatGPT came out, within 3 or 4 months, the entire board, says, "What's our AI strategy?" Well, guys, AI strategy, we've only been 90 days since ChatGPT launched, right?
Yeah.
But of course, everybody wants to see, well, what can this thing do? And then it gives them answers that look fantastic. It's like magic. And so now everybody wants to use it. And like you said, employees start to go, and we stop that immediately. We say, hold it, stop. You cannot upload your appraisal reports into ChatGPT. That's the training model for ChatGPT. You're just basically putting that all into a stream that you can't control. Similarly, we have very tightly controlled systems to not allow our information to be downloaded onto private USBs and the laptops and the migration of where that data can get out. We've had to severely tighten up. But our big concern was how do we put together a system so that the employees that want to try to understand what can be done here were experimenting in a safe place. And so within a few months of all of this, we got our head around this and we started to implement system strategies so that we had enterprise-wide scale to be able to use the systems, and they were in our space. Now we have, employees that they want to train, they want to build training models, and they want to build agents, and we've been spending a lot of time working with agentic AI to drive analysis, right? How can we have this thing read a lease? And what we found in a lot of instances is depending on the models that we license, whether it's Claude or ChatGPT or Microsoft Copilot or whatever, it'll give you a different answer every time. Well, I can't live with that, So one of the things that we're trying to communicate to our people right now is, do you understand the level of reliability that you're getting from this answer? Because you can read it and look at it and say, wow, that's very reliable. But the question is, can you replicate it? And this gets back to this idea that when someone relies on my opinion, they know how I got there.
Yeah.
And now our clients the banks are starting to come and they're saying, we want to know where in your appraisal you're using AI and what you did to verify. And so now this is creating a drag on the efficiency because we can create something very fast, but then to support it, it actually takes more time than to have just done it ourselves. So it's 2 steps forward, 3 steps back, or 1 step forward, 2 steps back. But we are being relentless about this right now. And on one hand, my management style is go fast and break shit. And on the other hand, I'm saying, I don't want to create a regulatory regime. I don't need consultants to tell me about data governance. I need us to realize that the number one thing that we have to be thinking about is the client's protection of their data. And the second thing we have to rely on is, how do we get this answer? Do we know how we got this answer?
Yeah.
And what we're doing is we're spending a lot of time with the AI actually trying to build agents that can source information, that can provide the source information for us by virtue of the context of the way in which they answer questions. So we did a little experiment. We built a private thing where we put the appraisal of real estate, uniform standards of professional appraisal practice, the interagency guidelines. These are all sort of definitive works of the appraisal world. And we ran agents against them to be able to ask the AI various questions. And then we said, okay, now let's train this thing to be able to tell us where it got the answer. So I can ask the thing a question, and I can say, what's the difference between surplus land and excess land? And it will give me a perfectly acceptable answer. But I don't know if it's the only acceptable answer, and I don't know where in the book it found it. So now we're training it to say, and here's my source information from whence I give you this answer, so that we can check the reliability of the answer. And then I looked at the data rights agreements with the Appraisal Foundation, which publishes USPAP, and the Appraisal Institute, and I had to go to both of these associations because we're not permitted to have AI running against their publications. So I asked
Oops.
them, can we do this?
Yeah.
Will you let us do this? Can we
Yeah.
license this? We've been in like 7 months worth of discussions and nobody will give me an answer. So
Wow.
everybody's trying to play catch up right now,
Yeah.
right? What data can you use? I can put a lot of data into,
Yeah.
an agentic environment, but if I don't have the rights to that data, I'm wasting my time. I'm wasting my money.
Yeah, it's an old question because I think similarly, if something is findable on Google, does that mean you have the right to use it
Mhm.
because it's available? Somebody put a lot of work into whatever it is you're looking at, that blog article or that report.
Absolutely.
Does that mean you can now take it and use it if you just read it and you're referencing it in something? Sure, but what are the rights, the usage rights around it? I think it's
But I will say that if you source it, the
yeah.
usage rights are usually pretty good. If it's
Yeah,
in
if
the public
you
domain,
give
and
them credit.
once you provide a source.
Yeah.
But my strategy here ultimately is to get to know Ed Sheeran and let him come in and show me how to play 3 chords and show with everybody that it's just the same 3 chords. And I'm going to do the same thing for the. I'm
If
going to be.
anyone knows
I'm
Ed
going to be the Ed
Sheeran out
Sheeran. I'm going to
there.
be the Ed Sheeran of the valuation world. That's my goal.
That's a fantastic button. That's going to be the tagline for this
I love
episode.
it. I love it.
Oh my gosh. Well, this has been so much fun. I think we're just about at an hour or so. It's been like that. So I don't want to take up too much more of your time since you got a very fancy lunch to get to.
Thank you.
But I'd love to wrap us up with a couple rapid fire questions.
Okay.
Just fun, little off the cuff answers. So, you ready?
I am.
If I handed you $50 million today and you had to spend it before 5 p.m. in the world of real estate, sorry,
It's all right.
where would you park it and why?
So before 5 p.m. today.
Yeah, so you
I
got
don't-
about 4 hours.
You want the answer before 5, or you want me to deploy $50 million before 5?
Deploy it before
You
5.
can't do it. I mean, you can't deploy $50 million by the end of the day. That's the problem. That's why people buy REIT. That's why people buy REIT
If
stocks.
I could wave my magic wand,
Yeah,
I
and have everything
REITs is
teed up.
REITs is an answer. You
It
could say
is, but it's
REITs.
that's the. I mean, look, the problem is hot money makes mistakes. I don't like
Sure.
the. I would spend some time with 50 million. I would diversify into a number of different areas. I would start if it was my personal 50 million, and I'm assuming that I'm not taking on any additional debt,
Yes, this
right?
is
Because
all
I don't want to
yours,
have to personally
cash.
sign. It's my cash and
Yeah.
the investment philosophy. I'd get real clear on what I want out of the investments,
Hmm.
and I'd take a little time doing that. But I'd buy 2 or 3 smaller $2-3 million net lease assets.
Mhm.
That's going to provide me the cash flow to pay for good lawyers and good advice. I'd probably buy some business type assets like self-storage because they are counter-cyclical to the economy. So buying self-storage on a counter-cyclical basis would work. And then I would put another 5 to 10 million into that, and then I'd take the remaining 30 million and I'd go completely opportunistic. I have a good friend in Miami. She's a developer named Alva Jane, and her main thesis is I don't want to buy any real estate that I can't add value to,
Mm-hmm.
and that's a hard thing to do if you think about it.
Yeah.
What is your ability to add value to the real estate?
Yeah.
And so from my perspective, I would tend to probably migrate into neighborhood community retail because I understand that market, and the real estate itself is always well located. It's well parked. It's land redevelopment opportunities that can be rezoned and upzoned, into the
Yeah.
future. And then big picture, I just never sell it. I'd hold it forever because
Yeah.
you never look back 30 years. When you first buy a real estate asset, you think maybe I even overpaid. And then 5 years from now, you're like, well, I didn't overpay, but I'm not sure I got a good deal.
Yep.
30 years ago, 30 years from now, you got a good deal. You're going to look
Yep.
back and say, oh, I was a genius. So I take my time. I
Sure.
go a little slower. I would diversify. I'd put about, like I said, 30 to 40% in stuff that's really cash flowing and counter-cyclical. And then I'd put the rest in opportunistic redevelopment, something that I could add value to.
Yeah, it's a great answer. I gotta connect you with a Don Tepman strip mall guy. He
Yes.
only does value add.
I love it. I love it.
And then he
Easy.
gets out of there.
Yep.
All right. What is the worst advice you've ever been given about being successful in appraisal?
I don't even remember. I blocked it out of my head. I don't know.
I've been getting that answer more and more often
I don't-
lately.
No, I mean, I listen to people's advice, and I love it when people give me advice. And I would tell everybody the same thing about my advice. Take it for what it's worth. I hope it applies to you. I hope you're able to pull something from it, or anything that I ever say. But at the end of the day, most of the bad advice never really even registered. The best advice that I ever had was from a very, very a gentleman named Bill Clayton in New Jersey. I grew up in New Jersey. at the Jersey Shore. And I was 18 or 19 years old. I had a good knowledge base about real estate, but I really hadn't been fully exposed yet. And this guy was so successful. He was a sand and gravel guy. He owned Clayton Sand and Gravel, and he was an icon in the industry, but he was a normal guy. He was a hardworking, normal. I don't want to say blue collar, but he had a way about him that was not pretentious whatsoever. And I happened to meet him one night at a dinner party, and I had him alone, and I just had to ask. And I said, Bill, if you could tell me one thing, like of your strategy, of your real estate strategy that's made you so successful, what would it be? And he looked at me and he said, it's very simple. He said, follow the pipe. And I didn't ask him what he meant because I knew what he meant. And what he meant was he buys real estate in areas where there was no sewer. And he would study the land use map to understand where the sewer was coming, because the ability to drain your sewer and your wastewater is what allows you to get density. So he would be buying real estate in areas that didn't have access to sewer, in low density areas. He'd buy tons of land. He was a sand and gravel guy. So he then used to go in there and grade it and take all the sand and gravel, sometimes making as much money as it cost him to buy the real estate.
Yeah.
And then 10 or 15 years from now, they'd provide sewer service, and he'd have one of the most valuable pieces of real estate in that neighborhood.
Wow.
And he did that over and over and over again in 2 or 3 different counties, and never worried about money ever again. So follow the pipe, best advice I've got. And today, that could also mean follow the pipe of the internet connectivity, follow the pipe of the
internet's a series
electricity.
of tubes.
Yeah, take electricity, capacity, clean water. All of that applies to the pipe. Follow the pipe.
Where's the infrastructure going?
Yeah, that's right. That's right.
Take notes, everybody.
There you go.
Fantastic advice.
Can we do something where I could work in Ryan Reynolds, so that could be the tagline of the podcast? Because
You
I'm
can
worried that Ed
mention
Sheeran.
Ryan Reynolds anytime. I love him.
I love him a little too.
He's so good. He's my marketing key. I've had a crush on him, full disclosure, since I was maybe 12 years old.
Wow.
Van Wilder. But he's a marketing genius.
Isn't he, though?
He's a business genius.
I agree.
Every company he buys, speaking of value add, he makes it better. He does it his own way, and then sells it for an amazing profit.
I mean, and given his physical deformities, it's amazing. That he's been
I know.
so
He's
successful.
so hideous. No, you are not Ryan. I'm sorry. Favorite tool or software that you use in your day-to-day?
Oh, geez, that's a good question. Favorite tool or software that I use in my day-to-day? I use so much email. But
Email?
I hate it. No, I hate it. I hate it. That's a good question. I say my calendar is probably my favorite. I live and die by the calendar.
That totally works.
Yeah.
People say they're like laser pointers too.
Oh, interesting.
Yeah, I've had all kinds of cool answers.
Now, if
for
I want to
that
go
one.
real old school, I'm going to go real old school, except I don't get to use it as much anymore as my HP 12C. I mean, let's be honest. That's the original Batman tool, right?
Yep. Yep, sure is. Okay,
Yep.
that's a perfect answer.
Thank you.
And then very last question for
Yes.
you. What is the most common misconception about the work you do or appraisal in general?
I would say the most common misconception is that we are trailing the market. There's this idea that because we're looking at the data that's occurring in the market, and of course, by the nature of time, the arrow of time, that's in the past. There's this misconception that appraisers are measuring the past. And it's a terrible, terrible misnomer. A lot of valuation professionals don't know how to really answer the question, but our job actually is to value the present worth of future benefits. What we're supposed to be doing is forecasting forward. How is this property going to perform? And then saying, what would somebody pay for the right to perform that in the future? So the common misconception is that we're looking backwards. And the reality is our job is to look forwards and bring it back to the current time frame.
Yeah.
And what we do to look at the past data is to just anchor those assumptions, those points of time, to be able to say this is where we are today and here's how things are going to perform forward. We do our own disservice too when we take assumptions and we just run with them. The rent's going to grow by 3%. Really? I mean, there's no other space being built, and maybe rent's going to grow faster than 3%. So appraisers get lazy sometimes. They just sort of put in some standard assumptions. In the residential world, a pool is worth 20 grand. You know, if you read a residential appraisal today, for the last 35 years of my career, a pool's been worth 20 grand. You can't build a pool for 20 grand.
No.
Oh, that's the depreciated cost of the pool. You just put the pool in last year. It cost $50,000. Oh, well, it didn't add that much value.
And did you do a cost seg analysis?
Right, exactly. So there's
Really?
this. I think that where the valuation profession doesn't meet the market is where it sort of uses these inherent rules of thumb, and it doesn't challenge them every now and then and go outside and say, this is wrong, I'm going to move this forward. But where we're doing the right job is when we're coming and saying, this is what we're doing, and here's what, it's our supported opinion, but present worth of future benefits. That's what we do.
Yeah, y'all are the oracles.
Exactly.
Someone tell Warren Buffett. You're on to him.
Tell him.
This has been so much fun. Anthony, really appreciate you flying all the way out here, taking the time. Where can folks get in touch with you if they want to connect, have more conversation?
I would say easiest place is www.irr.com. Website's got a search bar where you can find me, you can find anyone in any of our offices, you can find our market research. Everything about the company is out there and available. We're going to be building some APIs to let your agentic AI tap into some of that stuff pretty soon. Pretty excited about that. But if you want to find any of our people, irr.com is the way to be. And I am so excited. I'm glad we didn't do this over the telephone. In person is like way different, and I really appreciate you having me.
It's the best energy.
It
Thank
really
you
is.
so much.
Thanks, Shanti.
Yeah, and thank you everyone who tuned in today. If you enjoyed this episode, please let us know. Leave us a comment, review, rating on Apple Podcasts, Spotify, wherever you get your podcasts. For our full library of episodes and show notes, you can visit crexi.com/podcast. And you can also check out our YouTube channel for video recordings of each and every episode. Take care and be sure to tune in next time.